All right, joining me is Samir Kerbage, Chief Investment Officer at Hashdex, who's a crypto asset manager with about $1.2 billion in assets. That includes the first crypto index ETP in the US, the Hashdex NASDAQ Crypto Index US ETF, ticker NCIQ, that just launched in February, and it currently holds both Bitcoin and Ether. Now, Hashdex also offers a standalone spot Bitcoin ETF, the Hashdex Bitcoin ETF, great ticker symbol, DeFi. But look, Hashdex is what I would certainly call a crypto native fund issuer. They've been in this space for over 7 years now. And so, Samir, thank you for joining me.
Thank you, Nate. It's great to be here.
Well, it was great to just briefly meet with you in person at the Exchange Conference in Las Vegas last week. How was that for you?
Yeah, it was a great conference. Actually, it was my first time there, so I had a lot of fun.
Did you stay away from the gambling tables and the slot machines?
Yes, I managed to stay away from this. I had enough of crypto.
Well, for people who are not familiar with the Exchange Conference, this is attended by a lot of financial advisors. And I would say, generally speaking, more forward thinking advisors. Not everyone, right? There's some very traditional advisors there as well. I think it's really a nice cross section. But we're talking about, nearly 2,000 advisors there. And so to start, I'm just curious what you were hearing from advisors regarding crypto. Like, what was your sense on the overall vibe?
Yeah, so it's interesting because in the last 2 weeks, I've been to a bunch of different conferences and been like speaking with multiple advisors, both in the US, but also in Europe. And the general sense is that's still early. They're still looking into how they're going to approach the space. They're seeing more and more that this is here to stay and that they have to consider an allocation, but they're still trying to figure out how. So it's a very interesting moment in history, and I think all the things that are happening on the U.S. administration, they are helping to create this environment in which advisors are more comfortable into looking for crypto investment solutions.
Yeah, it's interesting because at the Exchange Conference, you were on a panel. It was moderated by Bloomberg's Eric Balchunas, and then Calamos's Matt Kaufman was on there. And you made a number of interesting points, but you did talk about how it is still very early for advisor adoption. But something else that you talked about that I thought was interesting was just how maybe the volatility that we're seeing in crypto, and we can talk about what we're seeing just this year, but maybe that is scaring off advisors to a certain degree. Do you think that recent volatility is something that is a big hurdle for advisors to jump over to get comfortable in considering crypto?
Well, actually, I think volatility is part of the characteristics of this asset class as it is right now. So with big opportunities, you have like also big risks, right? And that reflects on volatility. You can't have an asset class going up 100%, 150 to 100% without having some drawdowns of 20, 30%. That's very part of the like normal path of the journey. The interesting thing is that crypto's volatility has been going down in the last few years. So if you zoom out and look across like 5 to 10 years, volatility is reducing, and this is expected to like for an asset class that is maturing. So over time, maybe in 5 to 10 years, we're going to see like crypto's volatility as low as equities. But right now, it's a very emerging asset class. There's a lot of uncertainty, so it's very natural that its volatility is way bigger than what we see in equities or other asset classes. But what we're seeing, especially in the last 2 3 months, is a big risk off environment in which like all investors are like on the sidelines waiting to see more clarity on, especially on the macro side and the impact of all Trump like the economic policies and tariffs and all those things. So we're seeing like a clearly like that clearly like all the investors, both like in the U.S. or also when we look in Switzerland and Latin, investors are cautious right now with all asset classes.
Yeah, and I think to your earlier point, I think it's worth stating that, yeah, in the context of investing, and we can talk about a diversified portfolio a bit later, volatility is not necessarily a negative. If you're properly position sizing and you're rebalancing in a disciplined manner, volatility can actually work in your favor. But let me ask you this: if we take a step back, and I was asking you just about the general vibe at Exchange among advisors, I'm assuming that you come across advisors who are either unfamiliar with or they're just overall hesitant to consider investing in crypto, right? I'm sure you've had a lot of conversations with advisors who simply they don't get crypto, they don't believe in it, they think it's a scam. And so what is your typical message that you try to get across to that group of advisors?
Yeah. And it's even interesting to see how that's changing. Okay, because like when we started Hashdex back in 2018, I would say the majority of our conversations were around like why you should think about crypto as an investment, not only speculation, and why you should take it seriously. And right now, I would say 90% of the conversations are around how can I approach crypto, and like it should it be part of my investment portfolio, and if so, how? So we spend 90% of our time talking about this, and not much about like people just ignoring crypto completely or thinking that this is a scam. So this is very interesting to see how it's evolving. But the way we like to approach, especially for those investors that still like don't understand like the merit, is like seeing crypto as an evolution to the internet. Okay, so we're seeing a big like movement in the last 50 years of digital transformation. Okay, so it started with the personal computers, then we had the internet, we had the mobile phones. Now we're going to a phase in which we're digitizing value, and we are bringing some processes that like before blockchains we need to happen manually, we need like an intermediary. We're automating those processes with smart contracts. So this is basically a new technology that will allow us to increase our productivity in our society. And maybe like the only the only point that you need to ask yourself right now is crypto looking better in 5 years from now? Is it going to evolve as it is evolving, as it has evolved in the last 10 years? If the answer is yes, then you should consider some allocation to your portfolio. Doesn't need to be like a significant one. Like I mentioned in the panel, the difference between the poison and the medicine is the size of the dose, right? And this is very important for crypto.
With advisors, do you think the debut of spot Bitcoin ETFs last year, I mentioned Hashdex has a Bitcoin ETF, and of course, and we saw that followed by spot Ether ETFs. Do you think that helped change the way some advisors view crypto?
Definitely. And I think for two reasons. The first one is and the most significant one that resonated all across the globe is the SEC being like validating Bitcoin, in the sense that it's not like they like it, Bitcoin, especially the last SEC, they didn't like it. But the fact that you have a regulated product traded on a stock exchange in the largest capital market in the planet, that resonated everywhere. And people stay like the advisors and professional investors in general, they started to become more comfortable when looking especially into Bitcoin. And the second big impact is that before the Bitcoin ETFs, many advisors didn't have a way to access Bitcoin. They didn't have a way to offer that to their clients. So now they have it. And now they need to have this conversation. And our clients are asking for it. So I think those are the big reasons why like the introduction of the Bitcoin ETFs in the US has represented a significant milestone in like adoption of crypto for professional investors.
I want to talk specifically about the Hashdex crypto index ETF here in a moment, but before we do that, let's talk a little bit about crypto regulation. So my understanding is you were in Washington D.C. recently. You were meeting with policymakers. Can you tell us anything about that and perhaps what you would like to see happen from a regulatory perspective?
Yeah, so I was very impressed by what I saw in Washington D.C. Okay, so the environment there is way more progressive than I thought. Okay, so we hear about all those things and like the administration being pro crypto, and now the Congress, like the majority of the Congress being pro crypto, but the pace in which the things are evolving, and like how the Stablecoin Act, for instance, they're looking into having that bill passed uh, before the summer. Okay, so that's a very aggressive timeline, and we're seeing like we had some conversations in the Treasury Department with the SEC, and what we see across the administration is that crypto is a significant priority for this administration. They're especially looking into stable coins and how this can be like a significant path forward for the dollar dominance. And we're seeing an environment at the SEC in which they're open to hear the industry. They're open to have meetings. They're curious about it. They're asking questions. They're generally they're trying to design good policies for crypto overall. So this is very exciting. This is very exciting for the asset class, and I think like people are not realizing how transformative it will be in, I would say, 12 to 18 months. All those things that are happening right now in Washington D.C. So I couldn't be more optimistic. I think like things are evolving pretty well. The first big killer app of crypto beyond Bitcoin would probably be stablecoins. And we're already seeing a massive adoption of stablecoins outside of the US, especially in emerging markets. And if we have clarity in the US for banks to start issuing stablecoins, that's going to be also another like Bitcoin ETF-like moment for crypto, in which we're going to see just an explosion in adoption of crypto by traditional financial intermediaries and corporations.
I can only imagine what a breath of fresh air this recent regulatory shift must be for an issuer such as Hashdex. You have to be going into the office every day now with a little more wind behind your sails, I would imagine.
Definitely, because like all we want is clarity. Okay, we want to know the rules of the game to play the game. And Nate, like when we started the company back in 2018, we built the company to be like an asset manager in the US. So we wanted to have ETFs in the US, and we soon realized that like the environment was not there for us to have any kind of like crypto regulated asset manager in the US. So we had to go abroad. So we started our company, like our first fund was a Cayman fund, and then we launched like a family of funds in Brazil because the regulatory environment was better. We launched the crypto ETP family in Europe as well. And so we're finally excited to come back to the US and start actually building a business in the US because the regulatory clarity is improving. And I think we're going to see like a significant shift, especially in the crypto ETP space. We're going to see a significant clarity in the coming months coming from the SEC.
Yeah, and it's interesting. One of the reasons why I asked you about crypto regulation there, I had just asked you about the debut of spot Bitcoin and spot Ether ETFs and maybe how that helped advisor adoption. I think having regulatory clarity, obviously, that's going to help advisor and institutional adoption. The spot products did that a little bit, but I think as we get real regulation, that's going to make people who are managing money on behalf of others much more comfortable to come into the space. You mentioned, or you were alluding to, additional crypto ETPs coming to market, and I'm sure you're aware there are a boatload of filings for various crypto ETFs with the SEC. So there are digital asset ETF filings for XRP, Solana, Cardano, Avalanche. We could go on and on. Do you have any thoughts on the prospects for these ETFs based on what you were just saying with maybe getting a little more regulatory clarity? I'm assuming you're fairly optimistic, but is there anything that you think needs to happen in order for these products to come to market, just outside of the normal regulatory review?
So first, like I think what we see now is issuers testing what is going to be the limits, like where the SEC is going to draw the line. And the previous way to do this, like before in the last administration, the way to do this was to put filings out there and challenge the regulators. And what I'm feeling that the SEC, this administration is going to look into defining clear rules to avoid this, just like issuers trying everything and challenging the SEC all around. So that's what I hope to see from the SEC in the coming months, so that we don't need to guess which assets the SEC is going to approve and why, and then keep speculating on what needs to change. But what we think would make sense, and we have proposed that to the SEC, is that like they should look into like other methods to prevent fraud and manipulation other than just the surveillance sharing agreement and the Winklevoss standard that they have set for the in the first rejection of the Bitcoin ETFs. And what we've seen outside of the US again is the exchanges and the regulators defining clear rules like tradability, liquidity, market capitalization, support by institutional grade custodians and exchanges. So those are different criteria that will help mitigate the risk of fraud and manipulation without being too restrictive to only Bitcoin and Ether, or to only assets that have a futures market, etc. So hopefully this is like a path forward. This is one of the path forwards that the SEC could follow, that will allow the US to have more like different single asset ETPs being listed, and this would be great for the market. But most importantly, and this is speaks to what we do, like our core value proposition, we think we should have indices, right? So we should have multi-asset ETPs because they're essentially less risky than single asset ETPs. Okay, because especially if you go beyond Bitcoin and Ether, most of those assets, they're still very in the early stage. They're still trying to prove their use cases, right? They're still scaling, so it's too risky to have a single asset ETP of like all the different coins. But having an index with 10, 20, 30 assets is going to provide diversification, is going to provide broad exposure, and in the end, is going to be better for the investor. So this is also one of the things that we've been working with the SEC, is to think about how to deal with multi-asset ETPs and how they are essentially less risky than single asset ETPs when you go beyond Bitcoin.
I want to talk more about multi-asset products here in just a moment, but I want to go back to a comment that you made. And if I understood you correctly, it sounds like you do believe the SEC should draw the line somewhere in terms of what they approve. And clearly that would be data driven, whether we're talking about metrics like liquidity, so on and so forth. And what I'm getting at, Samir, is that, again, as I'm sure you're aware, there are filings, and this isn't a comment on any one digital asset, but there are filings for, say, Trump meme coin ETFs, or bonk ETFs, those sorts of things. So am I hearing you correctly in that you do think there should be a line somewhere in terms of what is allowed to come into the ETP wrapper?
Yes, definitely, because you need to custody it in a safe way. You need to be able to trade it in a safe way. You need to have price formation, so you need to have enough liquidity so that market makers could support a healthy ETF market. So there's a lot of things that need to be there for an ETF to work, and for an ETF to work well. So I think the line needs to be drawn somewhere. Let's see what the SEC is going to come up with.
Okay, so let's get into the multi-asset products, and I'll tie this into the discussion around the SEC. So I mentioned at the top, Hashdex does now offer the NASDAQ Crypto Index US ETF, ticker NCIQ. Again, this was the first crypto index ETP in the US. It currently holds both Bitcoin and Ether, right? This is market cap weighted. And my understanding is that very simply, as additional digital assets are approved in the ETF wrapper, you'll then be able to add them to this ETF, right? As long as they meet the underlying index's criteria. Do I have that correct?
Yeah, so the index, the Nasdaq Crypto Index US index, has a set of eligibility criteria, okay, which is pretty similar to what we have internationally. So our index, the Nasdaq Crypto Index outside of the US right now has 9 assets, okay, and it's market cap weighted. The Nasdaq Crypto Index US has basically the same eligibility criteria, but one rule more, in which, and right now the rule is that the asset must have a derivative that is listed on a CFTC regulated market. Okay, and so if the assets satisfy all those criteria, then the Nasdaq Oversight Committee might decide to include that asset in the index. And once they include in the index, Hashdex is going to propose to add that asset into the ETP through a 19 before listing rule with the exchange. So this is the design of this product. And the other characteristic of this product is right now we have a filing, a 19 before, a listing rule request also with the SEC to change the index from the Nasdaq Crypto Index US, which is currently restricted to only Bitcoin and Ether, and therefore will be restricted to only like futures market, like CFTC regulated futures market, to the Nasdaq Crypto Index, the same index that we have outside of the US. Okay, and if that listing rule is approved, then we can change the registration statement of the product to allow it to hold more assets. So go from 2 assets to 9 assets. So this is what we are working with the SEC, and hopefully we're going to see in the coming months, like multi-asset ETPs with more assets other than just Bitcoin and Ether.
And you were alluding to this earlier, but I'd love to have you just expand on the potential value of using a multi-asset approach, such as what we have with NCIQ versus using single asset ETPs. Just talk more about what you think some of the decision points should be for, say, an advisor or even an investor.
So, a core belief that we have is that crypto is bigger than just Bitcoin. Okay, so I like to compare what we see now in crypto with the internet back in the 90s. Okay, so if you look at the internet in the 90s, the email was the only big application of the internet, was the only thing that people used the internet for. And a lot of people thought that the email was the internet and vice versa, that it was all the same thing. The email and the internet, they're all the same thing. And when we look like 20, 30 years ahead, the emails is still relevant in our society. We still use it in our day-to-day, but was not the application of the internet that created the most value to our society, right? When we look at crypto, I'm seeing the same thing right now. So everyone is looking into Bitcoin. Most of the people think that Bitcoin and crypto is the same thing, and the only use for crypto is Bitcoin and store of value. But when we look like 20 or 30 years ahead, we're going to see a lot of different applications in crypto. I believe that Bitcoin will still be very relevant and will be even more relevant than it is right now, but it's not going to be the application of crypto that created the most value to our society. Okay, so we think that the crypto is bigger than Bitcoin, but we're still in a very early stage. And especially if you look at advisors and professional investors, when they're looking to allocate into this asset class, they're looking to single digit allocations. Okay, and what we normally see is between 1% and 5%. So for an asset class that you're only going to do a very small allocation, then you need to choose which assets you're buying. You might decide to just buy Bitcoin for a Bitcoin ETF, but then you are choosing to not be exposed to all the other optionalities that you have beyond crypto. And then you can choose to pick specific single assets. I can have Bitcoin, I can have Ether, and then in the future, if there is a Solana ETF, I might include it as well. But it's a lot of work for 1% of your portfolio, right? A very small part of your portfolio. And advisors, they have a lot of things to care about. They can't have that significant time allocated to crypto, studying crypto like we have. We love this asset class. I spend a lot of time studying it, but unfortunately, that's not for everyone, right? So then, you should implement the same approach that you implement for all asset classes, which is indexing, passive exposure. That's where you start your allocation. And then you can think about active management. But you start your core allocation with passive, with index, and that's what we think the advisors should look for when they are investing in crypto as well. They should look for a passive investment and index. There is a volatility that is going to evolve as the market evolves, and that's going to help them capture this asset class in the way that the asset class will grow over time. We don't know. Maybe Bitcoin is the only application out there, and the Nasdaq Crypto Index will be 100% Bitcoin. Or maybe we're going to see hundreds of different assets, and the Nasdaq Crypto Index will have 100 assets or 200 assets. It's too early to call the winners. So that's why we think a diversified approach is the best approach for advisors that are looking for this is strategic asset allocation.
Yeah, I think, Samir, all of that is extremely well said. I agree. And let's put Bitcoin aside for a moment. I want to come back and ask you a question around that, but let's put Bitcoin aside. Let's just assume that's a digital gold store value. Beyond that, there are a lot of crypto assets. It is very early. We don't know how all of this is going to play out, but I'm in your camp in that I'm very optimistic that there's going to be real value created here. But it is too early to pick winners. And in an emerging asset class like this, if you're allocating, to your point, say a 1% to 5% allocation in a diversified portfolio, to me, it does make a lot of sense to spread your bets around to make sure that you ultimately capture the winners there. And you're exactly right. That's no different than how a lot of advisors approach equities or fixed income or pretty much any asset class. But let me ask you this, coming back to Bitcoin, there has been a lot of debate recently around whether or not this is a store of value. It is digital gold because some would say chart that against, say, the triple Qs, it looks like a high beta asset. So I'm curious, we talked a bit earlier. Look, it's still early stage. I know Bitcoin, I think it was Bloomberg's Eric Balchunas has called it gold as a teenager. And so maybe it's still behaving that way. But how do you think about that? Because I know it's a topic of debate.
Yeah, so our investment thesis for Bitcoin is exactly what Eric mentioned. Bitcoin is a teenager version of the gold. So our thesis is that Bitcoin is an emerging digital store of value. Okay, so it's the first time in our society in which you can store value in the digital realm. Okay, and this is very new. This is something that most of the population is not used to, especially the older generation, which is the generation that currently controls most of the wealth. So what we believe is going to happen is over the coming years, there is a generational shift happening in our society. And wealth is being transferred from one generation like that grew in the analog world with papers and to a new generation that's digital native that grew with the internet that doesn't want to use paper anymore, that is asset light, that doesn't use real estate as store of value anymore, that doesn't want to hold like blocks of rocks as store of value. And this generation would prefer to invest in digital assets, would prefer to have their store of value in digital assets. And that's where we think Bitcoin will play a significant role as a store of value. So what we believe is that over time, as this generational shift happens, and it is happening, and the fact that we're seeing this new administration talking about a strategic Bitcoin reserve, this was unimaginable 5 years ago. Okay, so you can see that clearly this thesis is evolving. This is happening. So over time, Bitcoin might be consolidated as a very good store of value. And when that happens, the volatility of Bitcoin will probably be as low as the volatility of gold. Again, this is happening as well. Volatility is dropping. Bitcoin's volatility is reducing significantly. So this is our thesis. So right now, Bitcoin is a risk asset. So we don't think Bitcoin is a store of value right now. It's a hedge against inflation or a safe haven. Bitcoin is a risk asset. That's why when we see risk off movements in the market, we see Bitcoin dropping. That's why when we see risk on the environment in the market, we see Bitcoin ripping. And so Bitcoin is a risk asset right now, but a risk asset that in 5 or 10 years from now might become a digital gold. So this is the big opportunity. This is the big risk.
Okay, and then if we look at some of the other digital assets, let's take Ether, Solana, et cetera. I've always viewed those much more as technology plays, which would put them in certainly a risk asset bucket. Is that fair?
Yeah. So when we look beyond Bitcoin, we see four major investment theses. So you have the smart contract platforms as this new decentralized cloud computing platform that allows us to run financial applications and decentralized application 24/7. So this is a big chunk of our investment thesis. That's where we see Ether, Solana, and Cardano, and other smart contract platforms. And then you have three other theses which are on top of the smart contract platforms. So applications that you can use smart contracts for. And the first one is what I call the Internet Financial System, which is DeFi. Okay, so it's using the smart contract platforms to tokenize assets. And after those assets are tokenized, then you can use smart contracts to run financial services on top of those assets, right? So this is one of the theses. The second thesis is the Web 3.0. So it's the evolution of the internet as we use it right now in a way that protects our privacy. And that's where we think AI, for instance, will play a significant role. And the third one is digital culture. So it's using blockchain for collectibles, for meme coins, for different applications, social networks, so applications that are related to our digital culture. Our society is becoming more and more digital, and it's natural that we're going to see, digital collectibles, digital art, digital, memes, and all those kinds of things. So those are the four theses that we have beyond Bitcoin. And look, we don't need all those theses to materialize. We only need one. Like if we see the internet financial system coming up and all assets being tokenized, that's huge. That's hundreds of trillions of dollars in market capitalization are going to come to crypto. If we see on the Web 3.0, then it's still like you could have 10 or 20 trillion dollars in assets on the blockchains, and digital culture as well. The largest entertainment industry right now is digital gaming, is e-gaming. So it's not movie anymore. It's not music. It's gaming. So any of those applications can be a very significant market and can be like a huge growth for crypto. So that's why we're super excited about crypto, and we think like all those applications combined, they're way bigger than just store of value, right? Store of value is a very niche application.
Just a couple of minutes left here. I'm going to pull the thread on one of those topics that you just brought up, which is tokenization. And I'll tell you, that's absolutely been a recurring theme on this podcast since I launched this last year. And again, we don't have to go in depth here, but as someone who is an ETF issuer, I'm curious as to whether you see tokenization as ultimately replacing the ETF wrapper. Is that the natural evolution as we look out into the future, or is that just pie in the sky?
So that's a great question, because the ETF is a great technology, okay? But how I see things playing up is I don't think the tokenized versions of ETFs are going to replace ETFs all of a sudden. What I think is going to see something way more natural. So we have the Stablecoin Act right now. So if that act it's approved and we actually see banks issuing stablecoins, we're going to have our digital wallets with our stablecoins. We're going to start using stablecoins for payment instead of using wire networks or Venmo or credit cards. Okay, so all our dollar deposits are going to be tokenized. We're going to use this for trade finance. We're going to use this for remittances, right? So after like you have a huge base of tokenized money, the second natural demand is to have money market funds. So you need to have yield on that deposit, right? On that dollar deposit. So you're going to see a natural demand for having tokenized money market funds. And if part of like a big part of your wealth is tokenized in stablecoins, then you're going to prefer investing in tokenized assets than having to withdraw the stablecoin to transform into a dollar deposit and send this to a broker dealer to trade in the traditional ecosystem. So what I think is going to happen is that this new internet financial system is going to grow organically as we see more stable coins coming to market, as we see more deposits being tokenized as stable coins. So maybe in 5-10 years from now, the tokenized versions of the ETFs are going to be bigger than the ETF market cap right now. But it's not because it's a better technology necessarily, or because the ETF is not a good thing, but just because the money is tokenized. So if the money is tokenized, then it makes no sense to send it back to the traditional analog rails that take 2 days to settle, that you need like a bunch of forms. So I think it's going to be a natural movement.
Yeah, it's a natural evolution. I think that's really well articulated, that once money has moved over into this realm, you're not going to move it back to the TradFi side. And so it wants to interact in the DeFi world. Well, Samir, such an excellent discussion this week. Again, great seeing you in person last week at Exchange, but thank you for joining me.
Thank you, Nate. It was a pleasure.
That was Samir Kerbage, Chief Investment Officer at Hashdex. Hope everyone enjoyed this episode of Crypto Prime. Please leave a review or give us a like wherever you're listening or watching. That obviously helps other people find this show. And also always feel free to send me questions or comments to cryptoprimepodcast.com. See you again next week.
Crypto Prime is hosted by Nate Geraci, president of OTR Media LLC. Nate is also president of the investment advisory firm The ETF Store. While OTR Media LLC and the ETF Store are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by the ETF Store. This program is for informational purposes only and does not constitute investment advice. Investing in crypto assets involves substantial risk, including the potential loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Visit cryptoprimepodcast.com for more information.